Hello, and welcome to Virtual Investor Conferences. My name is Laura Hamilton, and on behalf of OTC Markets, we're very pleased you have joined us for our Community Bank's Virtual Investor Conference. We will start today with a keynote entitled Short-Term Challenges for the Industry, Long-Term Opportunities for Investors. Before I introduce our speakers, please note to submit your questions in the question box to the left of the slides. All of today's presentations will be recorded and available for 24/7 replay. Note that the market commentary provided by our speakers, Chris and Charlie, reflects the opinion of the speakers and not necessarily the viewpoint of their firm. At this point, I'm very pleased to welcome Charlie Crowley, Managing Director, and Chris Chapman, Managing Director of Janney Montgomery Scott. Welcome, Charlie and Chris.
Thanks, Laura, and it's a pleasure to be with you. Thanks to OTC Markets for all they do. Our firm is a market maker in hundreds of community bank stocks, and we've seen the good work that OTC does, helping community banks to get additional liquidity for their stock, which can help them, with shareholder transitions and raising capital and so forth. So we're very happy to be part of this. So obviously, everybody on the call, whether you're a banker or an investor, you've certainly been enduring the short-term challenges in the industry. So we're just going to give a little bit of, our reflections on what we are seeing in the industry, and then, again, hopefully long-term opportunities for long-term investors. So with that in mind, I think starting, you all know, the industry was under some pressure really once the Fed started its rapid rate increases. That created a little bit of uncertainty in the banking sector. It really took on a whole new level of anxiety for investors in particular when Silicon Valley went down in March. And as Jamie Dimon said, really the risks were hiding in plain sight. Silicon Valley was a public company. They had SEC filings disclosing where their investments were and so forth. But I think, again, in hindsight, you're looking at that particular case and why it's so much different from the community banks presenting today. And really, virtually all community banks, if you look in hindsight, Silicon Valley had explosive asset growth in a short period of time, which generally is not good in the banking industry. Their management team and board, really bought into the lower for longer mantra and had, huge securities risks that were, way underwater. It's obviously well known that they failed to replace their chief risk officer. And they were really unique in that they had such a huge percentage of their deposits that were, from very large depositors, a lot of private equity venture firms, among others, but that were uninsured. And then, it really kind of tipped over when they announced they were going to take a mammoth loss, turning unrealized losses into realized losses, and then try to fill the bucket, with a mammoth capital raise. And that kind of frightened their investors and their depositors, certainly. They lost $42 billion worth of deposits in one day. And that was really because of a Twitter herd, which nobody would have envisioned during the Great Recession. So that was a new risk that wasn't really in plain sight. But again, in our view, pretty much every community bank is quite a bit different from that in the profile. So obviously, a lot of smart people lost money on Silicon Valley. If you endured this roller coaster ride up and down, it was not a fun one. And again, for casual investors or people that don't really dig into the nuances of each bank, this did, in our view, create a little too much of a sense of distress and panic in some cases among investors. So that's obviously just one thing that sort of set the stage for where we are right now. Again, there currently are plenty of reasons that banks are under a little bit of pressure. Obviously, the pandemic spending spree created a whole lot of excess liquidity. It's not long ago that banks were really worried about their excess liquidity. Some put it to use a little bit too soon and a little bit too long, and perhaps lost sight of interest rate risk. The Fed clearly was wrong. They were, again, buying into the lower for longer and saying this is transitory inflation. And then, all of a sudden the horse is out of the barn and they're raising rates very, very quickly, which we'll talk about a little bit more. So that obviously has created a quick stress level where loans and securities are underwater, and banks have quickly gone from having excess liquidity to not enough in many cases to fund current loan demand. And they still need to make loans at the current higher yields to keep their margin up at a respectable level. Obviously, anytime there's concern of a recession, that is a trouble spot for bank investors. And anytime there's a sense that regulatory pressures will increase and the regulatory burden may flow downhill, even again for the community banks that had nothing to do with Silicon Valley and so forth. We saw that after the Great Recession. That can create a little bit of a sense of pessimism among bank investors. And then uncertainty in the economy is never good for banks. And that's not just recession fears, but obviously the drama going on in Washington, these days with the debt ceiling limit just creates uncertainty for the economy and certainly for the banking industry. We talked about the pace at which the Fed has increased rates. And again, they were probably too low for too long and then trying to catch up quickly. So if you just look at the last couple of periods when the Fed was raising rates, you can see the slope is a heck of a lot steeper this time. And that, again, just created a little bit of quicker stress and a little bit more uncertainty in the industry and in the economy. You've seen the shock with mortgage rates going up and everything else. It will slow the economy down as a result of this, and we're a little bit in uncharted territories as to how quickly that will happen. Speaking of that, whenever we've historically had an inverted yield curve, that has tended to be a pretty good predictor that a recession will follow. One thing we would note now, though, just in our observations talking to bankers and investors, is that a lot of people are focused on the Great Recession and how severe that was, and thinking if we have another recession or when we have another recession, that it's going to be that severe. It's really been 22 years since we've had a, quote, normal recession back to 2001. So a lot of fund managers and even a lot of bank credit officers and lenders, really weren't around then, haven't endured that. And it's even far fewer that can think back to the interest rate shocks, the savings loan crisis in the late 80s and different things that have happened since then. But assume that we do have a recession at some point. It doesn't necessarily mean that it's going to be like the Great Recession. And in our view, hopefully it will be a lot more mild if there is one. And perhaps the elusive soft landing is still in play. So again, the panic level, people are saying, oh my gosh, is there going to be a rash of bank failures? We really don't believe so. We think that the industry coming into this period was much stronger, and overall asset quality and capital levels are great. There were a whole lot of small banks that got swept under in the Great Recession because they were thin on capital. They had real estate exposure with high loan to value ratios, and then the value of the collateral plummeted, and it took down a lot of banks with it. Obviously, there are a few very big circles on this page. Hopefully, there won't be a lot of smaller circles to follow, but we think in general the industry is in very good position. And a big part of that reason, again, we mentioned capital levels. Coming into the Great Recession, a lot of banks were really trying to leverage their capital in an effort to keep their return on equity up, thinking that would drive their stock prices. And we certainly understand that return on equity is important. But coming into this period in the economy, the banking industry is much more strongly capitalized than it was before the Great Recession. And that's even after these TCE levels have been weakened quite a bit with AOCI hits that you've been hearing about and reading about and experiencing. So we think that, again, by and large, the industry is well capitalized and is in pretty good shape to ride through this period of turbulence. So I'll turn it to Chris.
Thanks, Charlie. And the next question, I guess, for investors would be if these concerns have been effectively factored into current stock prices. And I think the answer, at least to some extent, has to be yes when you look at the bars on this page. Note that the full extent of the stock declines aren't really evident in these multiples because, as Charlie just alluded to, the AOCI impact have reduced the denominators too, but the numerators have just fallen faster. The valuations are depressed at all levels, but the declines are greatest among the larger banks that are more liquid, tend to be more volatile on the way down and presumably on the way back up. What we see in down markets like this is a compression of multiples between the tiers, and you can see that the the delta between the largest group and the smallest was about 70 percentage points just a year ago, and it's roughly half that today. So each tier creates a bit of a valuation ceiling, and that pressure has pushed community bank stocks down to very low levels. We'll talk about M&A in a minute as well, but this can have a negative impact on M&A activity too. Of course, this bank stock action doesn't happen in a vacuum. So if we look back a little over 3 years, we can see the significant impact of the pandemic. Everything fell, but banks were among the slowest to recover, and the tech-heavy NASDAQ soared really as we adjusted to the new work-from-home reality. Banks gained some steam, began to close the gap into the early 2022 timeframe as the tech rally sort of fizzled. However, the impact of rapidly rising rates brought bank stocks back below pre-pandemic levels, even before the mess of the last couple of months, where the divergence has been very stark, with banks falling off a cliff, really, while the rest of the market has fared fairly well. So that speaks to relative performance. What does that mean for relative valuation? In most environments, bank stocks do trade at a little bit of a PE discount to the broader market. You can see the green line here over the last several years that's been in the 65 to 70% range. Right now, and I'll point out that these are forward earnings estimates, so this is not a backward-looking measure. This is taking analyst estimates into account, comparing the NASDAQ Bank Index to the S&P as a whole. And right now, with the NASDAQ Bank Index trading at just about 8 times forward earnings estimates, and the S&P trading at 19 times, we're at just over 40%. This is a historic, at least within the measured time frame here, low relative valuation between where banks are trading against the broader market. And you could see that on the prior slide too, with that great divergence between the banks and really everyone else. So unfortunately, as we know, stocks don't go up simply because the underlying companies deserve it. Someone, or in fact, probably lots of someones, need to buy them. So where will the buyers come from to stop the slide and support a recovery here? Within the institutional world, the bank-dedicated funds are always looking for good values, but they may not always have the free cash to move the market. And the generalists, I think we've seen, have largely moved away from banks and maybe waiting for a catalyst to return, whether that's some debt ceiling resolution, a period of steadily increasing earnings estimates. Any of those things might help. The Russell rebalance, with about 30 banks going back into that index this summer, will have a marginal positive impact, at least on a few stocks. We know that there is heightened short activity in bank stocks now, and that'll eventually have to reverse itself. It can provide a spark, but those really aren't going to be the supportive long-term holders that we want to see. So we've long believed that the best shareholders for most community banks are those connected to the bank. And it's also our observation that banks often don't do as good a job as they could of reaching those customers and friends and family and converting them into shareholders. We'd love to see more banks able to buy their own shares at these valuations, and certainly some are. But there are many that are hamstrung by tight capital and limited liquidity, thanks to the AOCI that we've mentioned a few times now. And the group that we think that can make the biggest difference in community banks is insiders, because of the signaling effect that they can have. So to all managers and directors, we'd say if you're frustrated with your own bank's stock price, that might mean that it's a really good time to buy. Charlie, I'll hand it back to you.
Thanks, Chris. So, again, I think those slides Chris went through kind of paint the picture of where we are right now. Is there any optimism for bank stock investors? Again, the best posture we think to take as investors is to have a long-term perspective, to be diversified. But, just in terms of reacting where we are right now, that relative PE slide that he just went through certainly gives a little bit of optimism, because, to the extent investors are in the equities market, they're always looking for certain sectors that are in favor, out of favor. Sometimes the market overshoots in optimism or pessimism. So we do think that, there will be some good opportunities, again, not across the board, but certainly some good opportunities. In terms of when that might happen, that's easier said than done. We're clearly in a challenging environment for banks. When you look at an inverted yield curve, we talked about how that can be an element of foreshadowing a possible recession. It also just makes it really hard for banks to make money when they're coming off virtually no cost funding, and now all of a sudden to fund new loan demand, they have to pay up at the margin on FHLB advances and brokered CDs and CD specials with their own customers and so forth. It's just very challenging. But in terms of, is there room for optimism? Again, the bond market is not saying that we believe we have runaway inflation for a long period of time. And so eventually we would hope that we would get back to a little bit of a flatter yield curve and then maybe at some point a more traditional, slightly upward moving yield curve. We don't think, with all the work the Fed has done, again, to kind of catch up from perhaps previous mistakes, we don't think they're going to be in a hurry to lower rates. So the challenge is that we might have this kind of environment for a little bit longer than most people hope. But we have a lot of bank friends that have AOCI issues that are kind of checking the 5 and 10-year Treasury rates all day, and hopefully we'll get to a point in the economy where that's not necessary, and some of that AOCI will start coming back. We talk about deposit pressures, and that's on the mind of all banks and all investors. Our colleagues in Janney's research department have done some good work to remind people that, again, deposits went up so dramatically with the stimulus spending, PPP loans and stimulus checks to individuals and so forth, that if deposits went way up and now they're coming back down, that's not necessarily a critical blow. Again, it's a lot more costly to replace those. But in general, you see how, again, after the pandemic hit, loan to deposit ratios went down very significantly and really to the lowest levels in quite some period of time. And that's tough for banks, tough to make money. Now, good banks are still seeing a reasonably healthy economy, still funding some loan growth, and we think it's best to not be frozen and just hold on to what you have. It's good to put out some money at the new higher rate. So we are seeing some improvement in loan to deposit rates, and that's a good thing, we think, for the sector and ultimately for earnings. Again, even if it's at a little bit tighter spread right now than people would want. And then we talked about asset quality, and the other difference from the Great Recession that we see coming into it. We talked about capital levels. By and large, the banks we talk to are still feeling very confident about their lending portfolios. They think they're in good loan-to-value levels on real estate. There certainly may be trouble spots in downtown office buildings and so forth, but we're coming out of a period of exceptionally healthy asset quality for the industry, and people have adopted to CECL without any big shocks to the system. So again, if we get to a period here where margins are tightened because of the funding pressures and charge-offs go up from really historically low levels to more normalized levels, that doesn't mean that banks are going to be hemorrhaging money and that you're going to see a lot of losses coming forward. So we feel reasonably good, and again, it's very much a bank by bank system. You do have to look at the credit risk and the interest rate risk in every individual bank, but we feel industry-wide that there's room for optimism and room for the industry to still make money, regardless of the environment. Chris?
Thanks, Charlie. If we look for signs of optimism just in past market trends, I think we can see it if we take a look at the year-by-year returns over the last almost 20 years here. I don't want to discount the fact that the Great Recession happened. It was bleak, but if we ignore that piece of the chart here, we've got 9 years that have been up. We've got 4 years that have been down, 4.5, I suppose. We're partway through this one that was flat. So we do see the cyclicality. Charlie mentioned the market's tendency to sometimes overreact a little bit, and I think that is reflected here. But I do think that the longer-term trend here has been generally net positive, and certainly for investors that have entered at the right times, entered in some of these down periods, they tend to have been followed by some very positive periods for bank stocks in the market. What does that mean for dividend yields? And this is we talk about sort of the opportunity to be paid to wait while the recovery unfolds here. Looking back over the last almost 20 years, again, we haven't seen a year with dividend yields at the median above 3%, even with all of the distress. And of course, dividends got cut much more deeply during the Great Recession. But with as low as valuations went there, we still didn't see such a spike in bank stock dividends. The last few years have been very good, very profitable. Banks have been increasing their dividends, and then you wipe away a good chunk of the denominator, and next thing you know, we have median dividend yields in excess of 3.5%, which should be a compelling complementary argument in favor of bank stocks, perhaps at these levels. And lastly, we referenced M&A briefly at the beginning, and so the question might be, what does M&A have to do with all of this? And frankly, the answer is quite a bit. Whether you're an investor looking at potential buyers who will benefit from improved performance, improved profitability on a pro forma basis, or you're looking at potential sellers who are in line to perhaps have a larger bank roll in and offer them a 30% or more market premium, M&A does absolutely have an impact on bank stock valuations. Unfortunately, what we see in times of uncertainty, market uncertainty, economic uncertainty, is bank M&A tends to hit the brakes. And you can see that in the Great Recession years, again, with the onset of the pandemic in 2020. And even relative to those periods, we're slower now. This interest rate environment, the AOCI impacts, again, some of that economic uncertainty, I suppose, looking forward, has put us in a spot where we are on pace now almost 5 months into this year for the slowest bank M&A year that we will have had in recorded history. That said, the flip side of this chart here is that there is a steady amount of activity that happens in this space. And typically coming out of slower periods, we do see that some of that pent-up demand gets unleashed, and I wouldn't necessarily expect it to be a heavy M&A wave going forward, but a return to a period where maybe 4 or 5% of the banks each year do deals. I think that's a reasonable expectation. That should also have a positive impact on the market and on bank stock valuations as well. Give it back to Charlie.
Yeah, thanks, Chris. And again, just picking up on an M&A slide, and not talking about these banks in particular yet, but we've seen over the years, if you look at individual stocks, there's certainly stocks that from time to time when the market is doing well, that we'd look at a given stock and say, gosh, they're trading at or maybe above their acquisition value. And there are times like now when these stocks have just been beaten down, and you think, boy, there could be some huge, not that they would take an opportunity like that, but there could be some huge M&A market premiums paid for a given bank. So, but I think, with respect to the companies you're going to hear from today, again, we appreciate what OTC Markets does to give a forum for banks like this to get their story out, because, they are all seeking to have more liquidity. They believe they have a good story to tell. We'll leave it up to our colleagues in Janney's terrific research department to talk about individual stock recommendations and estimates and so forth. So we're not going to go there. But if you look at the group of banks presenting today, it is interesting, just kind of glancing at the median line, solid capital, TCE, even though that's weakened in many cases by an AOCI hit, very solid to good profitability levels, decent efficiency ratio, decent loan to deposit ratio, and very good asset quality. So again, back at the dawn of the Great Recession, there were a lot of banks that were trading below book. And we would say, and investors would say, well, that's because they have a big embedded loss contained in their loan portfolio that hasn't been recognized yet. So that's why they're trading a discount to book. Today, we're seeing a lot of banks that are really well run and profitable and might be a little less profitable year over year, but the house is not on fire. And you see many banks that are trading at very modest price to book levels, very modest PE levels, and with pretty strong dividend yields. So I think each of these management teams will make their case today to try to convince you that they have a bright future and that their stock represents an attractive value. And we'll see what you think on that. But we do think, again, it's always hard to time the market. We never recommend that anybody try to do it. But we do think that despite all the doom and gloom we've been living through in recent periods, there will hopefully be some brighter days ahead for banks and for bank investors. So with that, I think we still have a few minutes for questions, if there are any. I see there are some in the chat room. So Chris, do you want to lead the charge on those, please?
Sure. And yes, as Charlie said, we have a couple questions. We'll try to get through at least a few of them here. And Charlie, the first one will be for you. What are your thoughts on how banks can address interest rate risk when you have depositors looking for higher rates relative to what banks are able to get as far as yields on loans?
Yeah, that is a big challenge right now, right? Again, you could see the reverse of what we saw with banks rushing in, a little bit too much. So, everything in moderation. You have to kind of look at how your loan book is repricing, how the deposit base is repricing, and keep an eye on that incremental spread. It's a complicated question, but interest rate risk and credit risk are the two fundamental challenges for bank managements and boards. And again, it's hard to predict. As we said, we hope we'll get to more level yield curve, a more normalized yield curve, but we don't know, quite now. So I think in every CEO suite and CFO suite and boardroom, there was that debate. How much short-term funding do you take on now to fund loan demand? How much do you go longer term, et cetera? No easy answers, very much bank specific.
All right, we've got another one on, and I'll take this one if that's okay, on opportunities in preferred equity. We've been talking about bank stocks as far as common equity, but what about opportunities with preferreds? And I'd say that there are absolutely some opportunities with bank preferreds. There are a number of publicly traded issues from banks, and many of them were trading at favorable levels above par value just before everything unfolded back in March. We've seen that in many cases the trading prices have dropped quite a bit. We've seen then the corresponding yields have crept up quite a bit, and that's market rates haven't changed that much in the meantime. So that's clearly a market commentary on the creditworthiness of the issuers, and if you believe in these banks, there are some very good yields available right now on from bank preferred stocks. Maybe time for one more, Charlie, and I'll give that one to you. We had a slide with the dividend yields, and certainly when you see a bar that's as high as the most recent year, it's a natural question, but are these yields safe?
Yeah, we do hear that a lot. And again, our sense is, even if, again, margins are a little bit tighter and charge-offs and provisions come up a little bit, the industry will be profitable, and most banks stand to be profitable if you look at pre-tax, pre-provision income and other metrics. So there really, in our view, for the vast majority of banks, shouldn't be any real reason for distress as to whether these dividend levels are safe. And again, as Chris was going through that, our view is you can kind of get paid to wait for the valuations to come back up, hopefully on these stocks. So we wouldn't be too worried about that in most cases.
All right, I think we should probably stop there. I can see our timer. We're nearing the end of our window, so I think we should thank everybody for joining us. Again, it's been great to spend the morning with you. And Charlie, closing comments?
Yeah, again, it is fun to speak, and it's a challenging environment, but we will get through it. And I think this is a time when a little bit of forward thinking and a little bit of entrepreneurial thinking can really serve banks well, and for investors that kind of hang in there with a long-term view, hopefully you'll be rewarded. So thanks again, everybody.